We're analyzing Amazon, stock ticker AMZN, to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Amazon. Then we're giving a final rating to the business when analyzing Amazon for your portfolio. Before we get into these valuable metrics, let's understand Amazon stock performance. Right now, Amazon trades for $102.60 per share. In the last year, their stock price is down about 30%. This underperforms the S&P 500 during this time. In the last 5 years, Amazon's stock price is compounding at just under 6% annually. In the last 10 years, Amazon is compounding at 23% annually. Very large growth for the business over this time. Going back prior to the global financial crisis, over more than 18 years, Amazon is compounding its stock price at 25% annually. This is still with the business being down 40% from its all-time highs in July of 2021. Amazon is one of the best performing stocks during this time period. Currently, Amazon trades $19 above their 52-week low. The company is down $47 from their 52-week high. Amazon is one of the largest businesses in the world. They have over a $1 trillion market cap. But why should we be paying close attention to Amazon? Amazon is a leading online retailer and one of the highest grossing e-commerce aggregators with $386 billion in net sales and approximately $578 billion in estimated physical and digital online gross merchandise volume in 2021. Retail-related revenue represents approximately 80% of the total, followed by Amazon Web Services, cloud computing, storage, database, and other offerings, which are between 10 and 15%, advertising services, which are about 5%, and other international segments constituting 25 to 30% of Amazon's non-AWS sales, led by Germany, the United Kingdom, and Japan. Amazon was incorporated in 1994 and is headquartered in Seattle, Washington. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. There are 2 key reasons for this. Over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. These business returns will be captured here by return on capital. The average publicly listed business earns about a 7% return on capital. By looking for a benchmark of 14% or higher, we can build in some margin of safety based off the overall quality of the business being about twice as good as average. Amazon has seen their returns on capital decline throughout this time frame. They earned just under 4% returns in their fiscal 2022, which was down from the 16% returns that they earned in 2018. Averaged out in the last 5 years, Amazon earns about a 10% average return on capital. While solidly above average, this is below the benchmark we're looking for, meaning this is an X on metric number 1 for Amazon. Metric number 2, we're taking a look at Amazon's growth. We want to see revenue, net income, and free cash flow growth in the last 5 years from Amazon. This metric is all or nothing. All 3 of these have to be up for this to be a check. During these 5 years, Amazon has more than doubled their revenues, which is insane for a business of their size. Their earnings have gone from being positive to now they are negative. Looking at their income statement, this is primarily driven by higher selling, general, and admin expenses, Amazon nearly tripling their R&D expenses, and the business taking a nearly $16 billion loss on the sale of investments related to Rivian. All of these are contributing factors for their net incomes, which are down. Amazon's free cash flows are also down over this time, in addition to what's impacting their net incomes. When we look at Amazon's cash flow statement, Amazon has nearly 5x their capital expenditures in the last 5 years alone. They significantly increased their capital expenditures from 2020 onwards, reinvesting absolutely huge sums in the business. Even though just their revenues are up, and this is an X on metric number 2, the primary reason for Amazon's net incomes and free cash flows being down are very heavy reinvestment back into the company. Metric number 3, we're looking for earnings per share growth in the last 5 years from Amazon. This allows us to take the perspective of an individual shareholder in Amazon. Because their earnings are now negative, Amazon's earnings per share are down during this time. Even if we backed out their investment loss, their earnings would still be down because of their huge R&D expense. In the last 5 years, Amazon has slightly diluted existing shareholders, issuing about 1.9% additional shares throughout this time. Again though, this is an X on metric number 3, and we're 0 for 3 so far on Amazon. Metric number 4, we're looking for free cash flow per share growth for Amazon. This metric will be very similar to Amazon's earnings per share. Amazon's free cash flows have gone from being positive to negative just like their earnings, and with their slight dilution, this is an X on metric number 4. We are 0 for 4 so far on Amazon. Again, their free cash flows are negative, primarily driven by their huge capex in recent years. So while this is going to be reflecting here on the business and potentially not overly penalize Amazon for their reinvestment. Metric number 5, we're evaluating how Amazon uses debt. During economic downturns, it's overly levered businesses that are likely at the greatest risk of poor outcomes. We want Amazon's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow Amazon has produced in their last 5 years. Amazon started this time frame with negative net debt, meaning they had $6.7 billion of cash in 2018. Currently, Amazon has about $100 billion worth of net debt. They've taken this on as they've significantly expanded their physical footprints in both their retail and their AWS segments. As Amazon's free cash flows have gone negative over this time, when we sum up Amazon's free cash flow, Amazon has only produced $33 billion of free cash flow throughout this period. That again is taking into account their huge capex, which could be potentially unfair for Amazon, but this is an X on metric number 5. The big metric of them all, metric number 6, we want Amazon's average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this may provide a reasonable starting point for evaluation of Amazon, and it will give us a slight risk premium to the yield of the 10-year treasury. Amazon currently has a $1.15 trillion total enterprise value. This is $1,152 billion. Amazon is a huge company. In the last 5 years, we learned Amazon produced $33 billion of free cash flow when we sum that up, meaning in an average year, Amazon produces just about $6.6 billion worth of free cash flow. When we divide that by their total enterprise value, that only gives us a 0.5% average free cash flow to enterprise value yield. That's very low compared to the yield of the 10-year treasury, and with Amazon having a negative current free cash flow to enterprise value yield, this is an X on metric number 6 for Amazon. Just because this is the case doesn't mean you throw out the business. This analysis is not a buy or sell recommendation of any security. It's not financial advice. You'll want to stick around as we use our discounted cash flow analysis to come to a more concrete estimate of Amazon's intrinsic value before giving our rating to the business. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Amazon, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for Amazon. A DCF model is based off the predictability of a company's free cash flows. It's like any model in any discipline, its outputs are sensitive to its inputs. To give a rough ballpark for Amazon, we're starting with an average of their free cash flows from 2018 to 2020. We're using historical assumptions to grow these into the future. Assuming Amazon grows their average free cash flows from before they started increasing their capex by 20% annually for the next 10 years, then having that growth rate be cut in half for the 10 years following that, adding in their tangible book value, which gives us an estimate of their tangible net worth. If we were seeking a 15% rate of return, which is the rate of return Warren Buffett is looking for from his investments, in addition to his margin of safety requirements. From today's valuations of Amazon, an estimate of their fair intrinsic value is around $66.60 per share. There are key points to keep in mind. Amazon has been a very predictable business in its past. That's not necessarily a guarantee for the future. The assumptions used for this model were skewed off of Amazon's heavy reinvestment in recent years. This only serves as a rough ballpark and is less accurate than some of the analysis we've done for other businesses. With these very high growth rates, even small changes in their discount rate would have a pretty big impact in what a fair value for Amazon would be. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before considering any potential investment decision, consult with your financial advisor. In just a moment, we'll give our rating to Amazon, but we have to address something first. What are the qualitative aspects of the business? Starting with the qualitative factors supporting a potential long thesis. Number 1, Amazon Prime memberships help attract and retain customers who spend more with Amazon. This reinforces a powerful network effect while bringing in recurring and high margin revenue. Number 2, high margin advertising and AWS are growing faster than the corporate average, which should continue to boost profitability over the next several years. Number 3, Amazon is the clear leader in e-commerce and enjoys unrivaled scale to continue to invest in growth opportunities and drive the very best customer experience. Then for the qualitative points supporting a potential short thesis. Number 1, Amazon may not be as successful in penetrating new retail categories such as luxury goods due to consumer preferences and an improved e-commerce experience from larger retailers. Number 2, new investments, notably in fulfillment, delivery, and AWS, should dampen free cash flow growth. Also, Amazon's penetration into some countries might be harder than in the United States due to worse logistics networks. Number 3, regulatory concerns are rising for large tech companies, including Amazon. Further, the firm may face increasing regulatory and compliance issues as it expands internationally. There you have it for a balanced perspective of some of the key qualitative aspects of Amazon. Now it's time to give our rating. In analyzing Amazon, stock ticker AMZN, we learned the business earns above average returns on capital, coming in a handful of percentage points below the benchmark we're looking for. Amazon has more than doubled their revenues in the last 5 years due to heavy reinvestment back in the company. Amazon's earnings and free cash flows have declined, and the company has a $100 billion net debt position currently. Due to this reinvestment, Amazon has a very small average free cash flow to enterprise value yield, and their current yield is negative. Amazon looks best here based off their revenue growth and their high reinvestment. Historically, revenue growth has been one of the only things that Amazon has screened for. This has been mentioned by some value investors, including Guy Spear. That doesn't make Amazon a better or a worse company. It's more difficult to assess some of this reinvestment. Combining the factors of our analysis, Amazon looks like a moderate candidate for further research. While it's a huge company, not the type that's most suited to potential mispricings, there are characteristics of the business that could obscure its true price, especially from less sophisticated investors. Performing our discounted cash flow analysis of Amazon, if you've done the work and you believe those historical growth assumptions, from today's valuations, a rough estimate of Amazon's fair intrinsic value is around $66.60 per share. You'll want to keep in mind the key points we touched on earlier. It's worth reiterating this analysis is not financial advice, it's not a buy or sell recommendation of any security. Before considering any potential investment decision, consult with your investment or financial advisor. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about an update on Amazon with me, and have a great day.